Hello and welcome into the KE Report. I'm your host, Shad Markwitz, and today we're getting an update on Blackrock Silver, traded on the TSX.V under the ticker BRC and on the OTCQX under the ticker BKRRF. We're joined today with the president and CEO of Blackrock Silver, Andrew Pollard. And Andrew, great to get you back on the show. We talked last month, and it was about your preliminary economic assessment at the Tonopah West Project in Nevada. And you mentioned that you'd have some big drilling going on, a 20,000 meter drill program, 3 drill rigs turning at the time. You came out with some news just on October the 15th, highlighting really some bonanza grade here, 3,745 grams per ton silver equivalent over 2.6 meters and multiple 1,000 grams per ton silver equivalent intercepts at the Tonopah West Project. I guess just as an initial statement here, walk us through some of these drill results that you just put out, the first batch here.
Sure. Well, listen, it's been a busy few days for us. As you saw, we put out news yesterday. First drill results, I think we've given out to the market in about a year and a half. But over that year and a half, our understanding is really crystallized of this project. And as you said, we laid out the economic case for this really high grade discovery we've got here pretty effectively in September with our PEA. What we're trying to do with this drilling is answer the few remaining unanswered questions that I think the market has about our project. And one of the things hanging over evaluation, at least until yesterday, was the fact that all of our resources were inferred. So people were saying, well, yeah, it's high grade, but does it really hang together? So what we wanted to do is take a really straightforward approach to drilling out the M&I here, and that's what we're doing. So our PEA, for example, laid out a 2.3-year payback period. So we're using that mine plan from the PEA to go about de-risking our ounces for the first 3 years of production. And the first results we put out yesterday were all from that program. And not only do they confirm that the high grade hangs together, and we're drilling out on 25-meter centers, but we've hit some of the highest grade intercepts we've ever seen at this project. And keep in perspective that this is the highest grade development stage project in the industry, in the silver industry, by a country mile. We're 55% higher grade, head grade, than our closest high grade peer. So, we're off to a good start here. We put out not only is the high grade hanging together, but we actually hit a new bonanza grade structure in some of the shallowest drilling that we've ever done here. So we hit over 8.5 kilograms per ton silver equivalent in a meter, over just over a meter, about 174 meters down hole. This is a new discovery that we've made. This will be, effectively the first system that you'd encounter once you go underground. So not only are we establishing plus kilogram continuity in this area where early mining is going to take place, but we're finding some new stuff closer to surface that we think will absolutely blow out the economic numbers as we look towards a follow-up study, hopefully similar timing next year.
Well, and Andrew, I will include underneath this interview for people listening in Figure 2, which shows the drill hole location map and shows where some of these drill holes you just released are from. But can you maybe give us a sneak preview of some of the other initiatives, besides tying some of that high grade together and the continuity, some of the other initiatives from this 20,000 meter drill program as it unfolds?
Yeah, so I said there was two things that hanging over sort of the, I guess, question marks on the project. One was, can we meaningfully convert our inferred resources to M&I? And we're off to a really good start here. The other big question mark, which we want to really show the market, is the upside potential. So that PEA that we put out in September, that showed about 8.6 million silver equivalent ounces per year over an 8-year mine life. And we want to show the market that we can get this well beyond 10 years. So that's what we're doing. We've got about a 1 kilometer of vein corridor that's bookended on both sides by mineralization. And we're going to be drilling out that 1 kilometer over the coming months. So we've got one of our drill rigs right now just doing some widely spaced holes across a handful of veins over that 1 kilometer corridor there, hopefully tying together the entire system into one big underground mine scenario. And we think, there's another 30 to 40% upside potential in new ounces in there. And in addition, for the PEA, we actually excluded or orphaned 12 million ounces from this mine plan that are off to the northwest, which are at the end of that kilometer of corridor that we're drilling out. So if we're successful, not only will we add a significant amount of new ounces from the drilling, the expansion drilling we're doing, but we'll also bring into the picture those 12 million ounces that we orphaned from this mine plan. So, what we're looking at here is, the base case economics that we put out. I mean, we're already looking at a 2-to-1 MPV to CapEx, 40% after tax IRR at $23 silver and 1900 gold. And we think, by the end of next year, with all the drilling we're going to be incorporating in here, we can get that mine life 12 or 13 years potentially on the same capex that we've got now. We've got a 1,500 ton per day mill that we're envisioning. The operation isn't going to change all that much. All we're going to be doing here is backfilling mine life and de-risking through that payback period. So we've got a huge opportunity to add more ounces quicker and cheaper than I think we've ever had over the next 6 to 8 months on the drills. And we're going to be able to wrap that up in the form of a new PEA later on next year.
Okay, so you'll have a new PEA coming out next year. I guess just diving back into the PEA, and we did discuss this in our last interview, and I'd encourage folks to go back and listen to that where we really dive under the hood on it. But maybe just a quick snapshot for people that are listening in. You went through some of the metrics there, Andrew, on the base case at 1900 gold and I think $23 per ounce silver. But what I was also impressed by was the sensitivity table you also showed at 2280 per ounce gold and 2760 per ounce silver, basically a base case plus 20%, that your IRR went up to 54%. So I can only imagine what it's like at $2,600 gold or $30 or $32 silver. Maybe just speak to the sensitivities of this project, as the metals prices are obviously quite a bit higher than the base case you're using.
For sure. Well, listen, the two amazing things about the project are the grade. Our head grade that you're going to be mining in the mine plan that we just filed is about 570 grams per ton silver equivalent. There's nothing else like this in the industry. And the other nice thing is the metallurgy. I mean, this is about as vanilla metallurgy as you could possibly have. It's just silver and gold. We've got a 3-stage crushing circuit in there, and then it's just cyanide agitation and Merrill-Crowe finish. So it'll be a doré at site. So high grade and straightforward metallurgy means it lends itself to very low cash costs. So just at the base case, I mean, all in cash costs are projected to be $11.96 an ounce silver equivalent, and we're going to be producing 8.6 million silver equivalent ounces per year on average. If you just want to get the exposure to silver, effectively at the base case scenario, we're producing silver when you factor in the gold credit byproduct, we're producing silver at negative 22 cents for every ounce. So talk about torque. And as you said, I mean, the grade makes it so that it's not all that sensitive to the downside. I mean, this will be a high margin producer pretty much at any metals price you use, but you got a lot of torque to the upside as well. So yeah, even that upside case we have is stale compared to what you're seeing in the market these days at metals prices. But this is going to be, a very, very high margin operation. And once again, I mean, if we can keep the capex about the same and add another 4 or 5 years of mine life and de-risk through that payback period, I think you're going to see absolutely blowout numbers this time next year. And, one thing that we'll see is, that early production, that's on our Bermuda vein and Merton vein systems. And in the resource that is included in this PEA, that inferred grade is around 600 grams per ton. Well, take a look at the drill results we just put out. Most every intercept in there is well above that 600 barometer. And as you tighten up the drill spacing, I mean, even if we just hit, roughly 600 in all of the drill holes, you'd see the average grade ratchet up as you're not penalized due to the spacing. But what we're seeing is higher than average grades on the drilling we're doing to tie together the high grade here, meaning our M&I grade should ratchet up significantly. And as I said, we also hit a brand new structure even closer to surface. I mean, I think you're going to see absolutely blowout numbers in the early years of a mining scenario here as we continue to drill this out and move it into the M&I column. So, shorter payback period, potentially better production numbers early on, leads to, much better economics for the whole project as things develop. But what we're looking at now, I mean, these are just the first drill results. We're popping out 2 to 3 core holes per week at site right now. And we've got one rig right now dedicated to that expansion drilling. So hopefully the next set of results we put out in the not too distant future will show more continuity for the M&I drilling, but we'll start to show the size potential too as we start laying our sights on those expansion holes on that kilometer gap.
Yeah, Andrew, it looks like just so many things working in the favor of the project, extending the mine life, raising the average grade, bringing in those orphaned ounces, showing continuity, helping the M&I categories. I mean, there's a lot going on. But when I look at the valuation of Blackrock Silver, I'm always a little puzzled because I keep hearing all the time that, Mexico is risky and that people are worried about it. And so I'll ask people, what about other jurisdictions? And I rarely hear people mention Nevada for silver, even though it's the silver state. And then I think about how many people talk about the base metals component in so many projects, and that most silver companies have silver in their name, but they're really zinc and lead and copper companies with a silver bycredit. And this one, you cracked me up last time. You said, our pesky co-credit is gold. So it's truly a precious metals project. You would think that would get a premium valuation. Maybe just talk to people that have sent in questions asking about where the valuation is relative to other companies.
Yeah, well, listen, I think you nailed it. And the valuation was even sillier in August, where I think we traded down to 22 cents. Here we are at 44 cents. We put these results out just yesterday and traded a couple million shares and up 12 to 15%, depending on which exchange you're looking at. But there's still a long way to go. I mean, if you look at how high grade ounces in the ground, lesser high grade ounces in the ground are trading there. Our peers, you got Dolly Varden and Vizsla both commanding about $1.40 an ounce. We're commanding 75 cents an ounce in the ground. And, that's with our head grade being about 55 to 60% higher grade than our other high grade peers. But that valuation gap is closing. I mean, 2 months ago, we were 40 cents. The reason Eric Sprott wrote us a $5 million check a few days after putting out our PEA in September, he paid above market and he did it without any half warrants or warrants associated, plus 4 month hold, because I mean, that valuation there just didn't make sense. And it still doesn't make sense, but it's trending up. And I think one of the reasons for that mismatch was just that the project stepped out of the spotlight for a decent duration there as we put our head down and did real work behind the scenes advancing the understanding of the deposit. I mean, we 2.5 extra ounces last year with a resource update we did in October. We increased our grade, but we didn't follow it up with drilling. And this year, when we did our first raise in January, we knew that the market just wasn't, that they weren't grasping the economic potential of our ounces. So we decided behind the scenes to put our head down and do the hard yards and get a PEA out there that crystallized the value, that showed what a straightforward operation this is going to be, how straightforward the metallurgy is, what it will cost to build a decline, and what a just how robust of a deposit this will be. And that turned out to be the right decision. But in doing that, we lost retail for a long time. They're going to be coming back now because what we're not only do we have that PEA that came out, which helps crystallize the value, but we've got drilling back here for the first time in a long time. And now, every drill hole, we're not just putting out random intercepts or, showing random ounces. What we're doing right now, people can follow along in real time over the next 6 to 8 months on the drills here and see not only us de-risking our ounces, converting the inferred to M&I, answering that big question, but also, they can see not just ounces being added, but mine life being added and follow along and do the math and see how consequential this program is going to be to blowing out our numbers, moving forward. So we're in a really good setup here, but you're correct. We're trading for half the ounce in the ground valuation than some of our peers on a PNAV basis. Right now we're about 0.2, whereas some of our other high grade peers at the PEA stage are trading for 0.5 or 0.6. Well, I'm undervalued based off every metric you've got, and you're going to have nothing but drill results coming out, drilling into that Bermuda vein. I mean, I see this as the highest grade structure in the industry, and we're going to be having a constant drumbeat of those and some big expansion holes, hopefully coming in pretty quickly here. So, was it the only better time to buy this would have been in August, and the second best time would have been yesterday. But hopefully, every day here on forward is going to get better than the last. So, yeah, we think this is going to be one of the better performers over the coming months here. We've got a lot of relative strength that we think we can close the gap on.
All right. Well, we'll wrap it up there for today, Andrew, but appreciate the update on these initial batch of drill results from this 2024 drill program. A lot of news still on tap to come from the drill bit, so we'll keep following along here at the KE Report. And if people listening in want to follow along, definitely click on the link below this interview. It takes you right over to the Blackrock Silver website, straight to their news section, so you can pay attention as these assays are released to the market. Andrew, keep us posted. We'll get you back on for an update, and looking forward to our next conversation.
Thanks very much. Great to be here.